So I think this will be some in-depth thought on where we're going to go on a general and basis for 2015. So without further ado, Shlomo, if you'll take over, appreciate it.
All right, thank you very much, Scott. Hello, everyone. I'm excited to be here with you today, and this is just the first days of the 2015, and actually this is the first full trading week for 2015, and so it's really excited a new year. So, and first of all, of course, a happy new year, and I also want to wish you a very successful year in your trading, and may your portfolio will prosper throughout this year. So today what my intention to do is to go through 2014 to summarize the year and actually to see what the 2014 year can implies us on 2015. So I want to find some kind of hints on 2014 that are going to give me idea how 2015 is going to shape like. So I'm going to share my view on 2015. We are going to see Wall Street projections. We have lots of statistics that I want to share with you regarding 2015. I also prepared a couple of surprises for you, so I want to equip you with a couple of opportunities. I think that that are going to, in my opinion, are going to stand out, are going to be really great for your portfolios. So without any further delays, let's start. So what you saw actually on the first and second trading day of 2015, and here's the S&P, the SPY, the ETF that tracks the S&P 500, and let's get to the daily chart, is not unlike the action throughout 2014, and quite possibly what is in store the rest of the year. But by that I mean, just when you think stocks are going higher, they retreat, and this is exactly what we saw in the last day of 2014 and the first day of 2015. And just when you think they are heading lower, they bounce, and this is what we are going to see soon. Don't let this thrilling action blind you from the fact that the long-term bull market is still intact. Keep your focus on the steadier fundamental horizon, such as the healthy economic data, and we are going to see this data, and we are also going to see the projection of Wall Street analysts for 2015, both on the technical side and also on the economic side. And that until that turns sour, best to be firmly long the stock market with as many top quality name stocks as possible. You know, I remember it was the famous line by James Carville during President Clinton's campaign in 1992 for investor, and he said that the economic stupid. For investors, the market's performance certainly brings back memories of the 1990s. It's the sixth straight year of gains in 2014. The Dow Jones is currently in the midst of its second longest annual winning streak on record, and the longest since, you guessed it, the 1990s. In that 9-year streak, which stretched from 1991 through 1999, the Dow Jones actually rallied, hear carefully, 336%. That's a lot. The current streak's gain of just 105% seems like a pittance in comparison, but keep in mind, at this point in the 1990s streak, the Dow Jones was up just 144%. James Carville's line from 1992 is just as applicable today. While investors and commentators complain that the market is a house of cards fueled by the free money of the Fed, strength in equities is being fueled in large part by economic growth. The current expansion in the US economy is on the verge of becoming the fifth longest in the last 100 plus years. Furthermore, while expansions typically show signs of slowing down at this stage of a recovery, this one has actually been picking up the pace just as the Fed has been pulling back. And this is, an amazing phenomena to watch. What was once an expansion characterized as being sluggish has actually morphed its way into one with above normal growth in 4 of the last 5 quarters, and this is amazing. I think that the last reading for the third quarter, actually the reading set at 5% growth. This is astonishing. The US economy is also in the midst of its longest uninterrupted stretch of job creation, and I'm talking about a stretch of 50 months on record. As we close out 2014, the outlook for the US consumer hasn't looked this positive in several years. Expenses in the form of energy prices are cratering, which translates to lower heating bills and lower prices at the pump. We can all feel it in our pockets. Borrowing and debt service costs are at historically low levels due to low interest rates. While costs have been falling, Americans and all the citizens around the world are earning more, and due to the dollar's strength, the money the American earn is going further. Granted, things can and often do change quickly, but at this moment of time, things are looking up for the average American. Judging from this view, you would think that investors should be buying with both hands. Not so fast. To at least some degree, a lot of this is already priced into the market, and as we are going to switch back to the S&P 500 price action, we can see a great movement all along the year. But if we are going to take even a larger time frame from the weekly or on the weekly time frame, this is actually quite a long stretch upside. So a lot of it actually is already baked into the prices. The market is closing off 2014 at all-time highs. Valuation is above average, so not cheap, and we are going to discuss valuation later. But we are in a bull market, we have to remember that, and valuations typically become richer in bull markets. This is something we can expect, this is something we should expect. We aren't yet at the stage where valuations are high relative to the peaks of prior bull markets. All in all, valuations are no longer working in investors' favor, but on the other side, they aren't a major headwind either till now. The biggest wild card of them all, though, will be the Fed. there seems to be a growing confidence that the Fed will manage its way out of the easy money of the last 7 years flawlessly. But history shows that these types of exits can end up messy more often than they are smooth. A Fed that's more aggressive than expected in raising rates could be the spark for the long-awaited 10% correction, and actually we haven't seen such a correction since 2012. So actually we need to get back to August, November, October 2012 to actually spot such a 10% correction. History shows that when the Fed acts after an extended pause, there is nearly always at least some sort of short-term decline. The bulls have low inflation and economic weakness around the rest of the world working in their favor as factors that would delay the inevitable hike in rates or slow down the pace of hikes. While the Fed's actions of the last several decades have caused some to say their number one indicator is the S&P 500, Janet Yellen appears refreshingly less concerned with the fluctuations of the equity market, and she is much more concerned with actual economic data. In the words of James Carville, once again, it's the economy, stupid, and let's get back to the slideshow. For investors, it's the economy and the Fed. So we are now going to go through a couple of slides, and we are going to drill into the statistics and into Wall Street projections for 2015. But even before that, I just wanted to show you our Facebook page, and actually a surprise. We've already prepared you on our page. So you are more than welcome, and we are welcome all of you to become our friends on Facebook. You can just search in Facebook for Shlomo Cooper Trading, or just click www.facebook.com/shlomo.trading, and here you are going to see all the great ideas and the great materials and posts that we are delivering to you each day and each week under this platform. Daily posts and daily hot stocks and weekly picks and live trading videos and educational videos and trading ideas and lots of free stuff for you. And actually, right now, if you are going to turn your browser to our Facebook page, you are going to discover what is, in my opinion, one of the biggest turnaround story of 2015. And this investment can make tens of percent, and actually you should act by the end of January, for my opinion, to capitalize the best gains that these investments store for you. And the whole concept and my whole argument for these investments, and how actually you can participate and how you should take action in order to capitalize on that idea, it's all in our Facebook page. All right, let's move on, and we'll start with the S&P 500, how it went through 2014. So in front of our eyes right now, we can see a graphic that takes a good look at the performance of the S&P 500 in 2014. The first chart actually shows the daily closing prices of the index throughout the year, from the start of January till the end of December, with up and down months highlighted in either green For February and December it was green, or either in red like January and July 2014 that actually were negative months. We can also see the monthly performance under each month. The second chart at the bottom shows the average performance of the S&P by day of the week in 2014, and from this we can actually see that Mondays and Thursdays were the worst days of the week in 2014, both actually averaging declines. Tuesdays and Wednesdays saw the biggest gains of 0.15% on Tuesdays and 0.10% on a Wednesday, while Friday was modestly positive. By the way, if you want to get all of the slides we are going to see and we are going to cover, all you need is just to turn to our Facebook page. Tomorrow I'm going to publish a link where you will be able to download all of this great material to your computer. What was the best strategy in 2014? And actually this strategy is going back for the last 3 or 4 years, and that was by the dips. One of the hallmarks of the equity markets over the past 3 years has been a buy the dips mentality. As equity markets have trended higher, sell-offs have been very short, followed by mean reverting gains back to trend and then steady gains before the next brief sell-offs. And this action we can actually see great here on the chart on the S&P 500. This trend was also coupled to a trend downwards in volatility, and on the bottom we can see the VIX. The VIX is the index. This is the index that tracks the volatility in the S&P 500, and here we can see a steadily decline until July 2014. This is where my marker is right now pointing. And from here we saw a shift in the volatility. The volatility actually raised its ugly head. Over the course of roughly the last 2 years, a reading of 20 on the VIX has been a reliable buy signal, usually coming within a few days or percentage points off the bottom. And here I just put a line on the 20 VIX, and just see how when the VIX went to the area of the 20, this was a bottom in the market, and that was actually a good buy signal. And again, when the VIX went back to the 20, it was a great dip to buy. And once again, around April 2014, it was a great dip to buy when the VIX went back to the 20 reading of the VIX once again in October, and once again just at the middle of December when the VIX soared above the 20, and that was actually another higher low for the market. But after more than 2 years of ever lower volatility, the VIX has begun ticking up steadily, as we can see here on the chart at the bottom, as equity market swings around the mean appear to be getting larger. And I just actually tried to draw here the line of the mean, and as we can see, the chart of the S&P is just fluctuating above and below the mean line. Eventually, of course, the secular bull market trend with variations around it will be broken. But for now, a slightly elevated VIX appears to simply signal, I think, larger variation around the continued upward trend, as we can see here. Great. This is a chart that is going back to 2012. Of course, a Fed hike in 2015, and we are expecting a Fed hike in the second half of 2015. I believe it's going to be somewhere around September, or continued acceleration in growth, or other events could shift the trend either to the upside or downside, shifting both returns and volatility in the year ahead. So let's make a little bit of a pause and let's take a look on the performance around the globe. And here we can see our ETF matrix highlighting the performance of various asset classes in 2014, and we are showing you here also the performance for December, the performance for the fourth quarter, Q4, and the performance for the whole year. The left side of the slide is showing you the US equity related ETFs, while the right side of the matrix contains international ETFs. And you know, this is a great way. Wall Street actually gives you a way to take take action and to participate actually in any spot around the world, whether it's of course United States, but also if it's in Europe, if it's in India, if it's in Russia, in Brazil. Everything you can get an exposure through great variety of ETFs that are all being traded in Wall Street in the United States. So let's start with US equity, and US equity ETFs saw broad-based gains in 2014. Everything here is with a lot of green, especially in large caps. The S&P 500 actually ended December with a gain of 0.73%. It was a great fourth quarter with almost 6% of gains, and it actually was able to end the year with a double-digit performance of more than 13%. Actually, the best large index from a performance point of view was the Nasdaq 100, the QQQ. The QQQ actually went up, and although it was slightly lower for December, it managed to end the year with almost 20%. If we are going to get to move to the small caps, the small caps actually underperformed significantly all year, but they are ending the year in positive territory at least. And here the IWM that tracks the Russell 2000, that is the most the smallest companies in the market value. In the market value in Wall Street, they actually managed to end the year with almost 5%, but that was largely because of the gains, because of the great performance in Q4, where they saw a great gains of more than 10%. In an up year, you don't expect to see utilities leading the way, and utilities were actually, the sector of utilities was the best performing sector in the United States. And if you want to, and this is the XLU, all right, the XLU. Let's put it on the chart right now. The XLU is the ETF that tracks the utilities sector. Here we can see the weekly chart of the XLU. That was by far the best sector among all the 10 sectors that are part of the S&P 500. And the utility sector actually surged 30% in 2014. In a growth environment, the majority of portfolio managers aren't positioned in utilities. Thus, the big underperformance we saw from portfolio managers this year is due to that. Many international markets and and let's get back to the matrix. Lots of red in the international market, and Russia was by far the most awful performance stock exchange around the globe, with a decline, with a plunge of almost 50%. Half of it actually came only in December, when Putin actually surprisingly raised the interest rate to more than 7%. But it was also an awful year for Brazil, which went down 18%. The best, actually, the best performance came from India, and you can actually get an exposure to India by taking the ETF INP. It actually ended the year with 20%, very, very close to what we saw in the United States, but it would have been much larger and much substantial gains if we don't have the awful December performance, when it went down and gave back gains of more than 7.5%. So actually, when we are watching the international markets, it's and practically all commodities ended a dip in the red on the year. It's all highlighting for us that the US on the left side was certainly where the gains were at, and it's great that this is our main focus. The S&P 500 continued within its multi-year bull market in 2014, and I actually wanted to take some perspective and to see how this current bull market is actually acting, and where it is placed among other bull markets, among the Hall of Fame of the big historical bull markets. So right now, the index's 13% gain in 2014 leaves it up 209% since the bull market began on March the 9th, 2009. Here we are seeing, we are watching right now two tables looking at historical bull markets for the S&P 500 since the index came into existence in 1928. Now, as we know, the definition of a bull market is categorized as a 20% plus rally that was preceded by a 20% plus decline. The table on the left sorts bull markets, all the biggest bull markets in the history by length in calendar days, and here we can see where the date where the rally began, where it ended, and the percent change of the whole rally, and the length in days. The table on the right sorts bull markets by gains. Alright, so as shown, the current bull market for the index has seen a gain of 209%, and I marked it in yellow, over 2,121 calendar days. This means that the gains during the current bull market are now at twice the gains of the average bull market in history, and as we can see, the average rally in the bull market is 105%. The length of 2,121 days for the current bull market is more than twice the length of 938 days for the average bull market, and this is actually what must give you to be in wonder. This actually what is astonishing about the current bull market. The current bull market right now ranks as the fourth strongest and fourth longest bull market on record. To move actually into third place in terms of length, and let's go to the left table, the bull needs to continue until May 6th, 2015. That's about another 5 months. To move into third place in terms of strength and overtake the 228.81% rally during the 82 to 87 bull market, the index needs to gain another around 7% from here and move up to 2,224 points. This is quite amazing. All right. Let's see that statistics and annual returns from a different point of view, and this is the point of view of the Dow Jones. In the chart right now, we show annual returns for the Dow Jones going back to 1,900, grouped according to their percentage moves. Underneath each group, we highlight the average annual change for the Dow in the year after similar moves. So actually, this is a statistical study that gives us an idea how we or what should we expect from the Dow Jones to do in 2015. As shown, the Dow's 8.9% gain in 2014 puts it into the 0% to 10% category. Following years in which the Dow has gained 0 to 10% in the past, the index has averaged a gain of 7.2% with positive returns 63% of the time. And out of the 12 performance categories shown below, the year after a 0 to 10% again has seen the fourth best average returns. And by the way, after 40% plus, on average the Dow Jones goes almost 25%, but also after an awful year like when the Dow Jones is plunging 20% or 30%, this is a good signal to be in the market for the next year, because after that it's making 39% and 22% respectively. All right, let's move on. And what are the projections of the biggest investment house in Wall Street for the S&P 500 year end? So here we highlight the projected 2015 year end S&P 500 price targets of the major Wall Street strategies as compiled by Bloomberg. The table on the left sorts. Where is my marker? Here it is. All right, here's my laser. All right, so on the left, we sort the strategists in alphabetical order from a Bank of America and Bank of Montreal at the top to Oppenheimer and UBS at the bottom. And the table on the right sorts the strategists from most to least bullish. Here we can see Canaccord and Oppenheimer at the top. There is not much new from Wall Street strategists in terms of expectations. Your typical strategist, we have to understand, will project returns of 5 to 10%, and as shown here on the slide, the average price target for the end of 2015 stands at 2,213. This equates to a gain of just over 5.5% for the S&P 500 in 2015. We've seen this number more bullish in the past, so I would consider the strategist community as slightly more bearish on the year ahead than normal. Maybe because this is the sixth yearly gain in a row. Strategists are very bunched together with the 2015 estimates, and this is another thing that we can see, no one really sticking their necks out. The most bearish strategist is expecting a small gain of less than 1%, and actually we can see Berkeley's and Goldman Sachs, they are the bearish one here on the list, while the most bullish strategist is expecting in a gain of roughly 12%. Canaccord has the most bullish price target with almost 12%, and after that Oppenheimer with a gain of almost 10.5%. And I think everyone would sign on a performance like that in 2015. From these statistics, from these figures, let's get to the economy, because we know that at the end we are talking about stocks, and stocks actually they are pricing upon their fundamentals, upon the earnings that the company is going to deliver to investors. So let's see what are the consensus estimates for the revenue and for the earnings in 2015. So this is a look at bottom-ups 2014 earnings and revenue growth projections for the S&P 500 and its 10 sectors we will see in the next slide. And as shown, the S&P 500 is expected to see solid earnings growth of 6.4% for the full year of 2015. The EPS is the green column, and the blue column is the revenue estimate. Actually, a 6.4% growth is actually down from an estimate of 9% plus EPS growth that we saw heading into 2014 one year ago. Revenue growth is expected to be much more moderate in 2015, with full year estimates at just over 4%. Let's drill down to the sectors, and 4 sectors are projected to see double-digit earnings growth in 2015: consumer discretionary, technology, materials, and healthcare. They are all showing the best EPS growth estimates. Industrials and financials are just below these 4 at 9% and 7% respectively. Energy is actually the big standout, with the dramatic drop in oil prices expected to cause energy sector earnings to fall more than 21% in 2015. But that doesn't mean when the round of earnings is going to take place but by the way, we are starting the Q1 round of all the earnings season in another week. It doesn't mean that the energy sector is going to fall further, because it's all being already priced, it's already been baked into the price right now. So if the energy companies are going to let down the investors less than expected, actually we can see a rally in the energy names. And by the way, I think that many energy names, many energy companies in that space were overshooting. That means that they went much further, they fell much further than they actually should. Actually, investors just throw the water with the baby, and I think we have here an opportunity in a generation of picking some good solid energy stocks, but we will cover that maybe in another webinar. Let's move forward And let's ask the question about pricing, about valuation. And the most interesting questions for all investors is, should we get into the market, into Wall Street, after 5.5 years of gains, after the market has actually made more than 200% in gains? Maybe the market is just too high, maybe the prices are just too expensive. So let's try to answer this question from the forward PE ratio. It is always dicey to try and place a valuation on future earnings. We know all too well that analysts have a tendency of being overly optimistic in their assumptions when things are going well, and overly dour when things are bad. With that caveat in mind, the chart here shows the PE ratio of the S&P 500 based on 12-month forward earnings. For this chart, we looked at actual 12-month forward earnings were available and have used estimated earnings to cover the next 4 quarters. So what we see here on the chart, for the full 2015, analysts are expecting earnings of $131.54 for the all S&P 500 companies, which works out to a PE of 15.83. This is where my laser is pointing right now. That works out to a higher than average forward multiple, but once again, because the long-term average of the PE is 14.85, and here on the chart we can see the forward PE from 1928, actually all the data that is available from when the S&P 500 was established, together alongside with an horizontal red line, which is the long-term average. So we can see that here at the end of 2014 we are slightly above the long-term average PE, but a couple of things about that. First of all, I would caution that these are only estimated earnings, and the actual figure will likely be very different. Falling energy prices are just one factor that will have both a positive and negative impact on earnings next year. Just for perspective though, to get back down to the historical average, we would need to see the S&P 500 trade down to about 1950, or about 7.5% below current levels. But on the other side, you know, when you have a starved man and you are giving him a plate with a lot of food on it, he's not just going to eat until he's good, until he's feeling back to life, but you know, he's going to actually he's going to eat all the plate. He's going to eat until he's fed up. So and this is exactly what we should expect here. The market bottomed down around 2009, March 2009, and we just got from a very drastic low levels. We just went back to a little over the average. Usually you should expect this price to go much higher. Today the public is not participating in the whole celebration in Wall Street. You don't hear that the funds are getting a lot of inflows. There is a positive inflow, but not very large. The public is actually remember all the bad things from the last the last Great Depression and the last great collapse in the stock market in 2008, and they are all just too afraid to get back to the market. When and if they will get back to the market, then we are actually going to see a leap in the valuation, and that can actually push the market with 10% upwards. That doesn't mean it's going to happen, but this is one of the scenario we should take into consideration. All right, so we saw a little bit. All right. We saw a little bit what 2014 was like, and I want to share my view regarding 2015, how I think 2015 is going to shape out. So maybe I would like to even go a little bit back to 2013, and just to remind you that in 2013 the S&P 500 gained more than 30%, and of course that was a blessing, but for the investors that participated in that market, and actually we were in this market, but it was a curse for the investors in 2014. A blessing because it padded all of our portfolios, a curse because the gains came far too easily, making 2014 a brutal environment by comparison. And as we saw, there was a lot of volatility. Back to the SPY, there was a lot of volatility throughout 2014. Yes, the S&P is up on the year, but still many small caps and glamour growth stocks are in the red, plus the volatility made it like a house of mirrors where you were never quite sure what to make of the environment landscape. Now we get to put this miserable year behind us as we look ahead to 2015, and after much contemplation, here is my outlook. And if I want to summarize it by one phrase, here it is, one sentence: 2015 will be exactly like 2014. End of commentary. You want more? All right, so here comes more. Yes, all right. So this is the final conclusion that next year will be far too similar to 2014. Modest gains and more volatility than you would like. But if you know that in advance, then it should make it easier to profitably navigate the waters, and we are all going to do it together. So let's cover a couple of the topics to get you in the best position to prosper in the year ahead. And I want to cover why still bullish. We will make a couple of predictions, and I want also to equip you with potential pitfalls. All right, and this is very, very important. So why still bullish? A long-term bull market stays in place until one of two things happens. A, recession looms on the horizon, awakening the next bear, the bear market. B, valuations get stretched. So let's discuss each concept. As for recession looming on the horizon, that just doesn't add up given how economic data continues to improve in the US. Truly, the readings for manufacturing service retail and employment, and we are going to get the next round of employment figures this week towards Friday, are at the healthiest level since before the Great Recession, and this explains why the average GDP reading the past 3 quarters is more than 4%. I appreciate that on average there has been a recession every 5 to 6 years, but that is often because the boom times are too good, leading to excesses that bring to life the next contraction. The beauty of model through growth seen in the first several years of this expansion is that there are no excesses or bubbles at this time, and this is very important to understand. We don't see a bubble right now, so no fear of an imminent recession. Now let's address the other side of the coin, valuation. And I know folks who point to a historical average PE of 15 in order to say that this market is getting stretched given the trailing PE of 18, and we've just seen one of these charts, but however there is much more to the story. First, the market looks forward. The stock exchange looks forward. This is not a lesson in history. In this case, we should be looking at the PE based upon estimates for the coming year, which are in the neighborhood of $133 per share for the S&P 500, which creates, as we saw, a PE of 15.4 at this time, much cheaper. Second, PEs in the later stages of bull markets typically move higher, as I explained, given the confidence folks have in a positive outcome. So a PE of 17 to 18 is more standard at this stage of the game. So actually we are seeing right now cheaper PE than we can expect at this stage of the bull market. Lastly, and most importantly, is the relationship stocks have with treasury rates. In general, the earnings yield for stocks is 3% higher than the 10-year treasury. So let's do that math. Earnings yields is the inverse of PE. So dividing the current price of the S&P by the $133 in expected earnings comes to an earning yield of 6.3%, whereas the 10-year treasury is only providing a meager of 2.2% yield for investors. Given this historical relationship, there is still ample upside for stocks. Let's talk about 2015 predictions. The bull market has already rallied more than 200% since it began in March 2009. Thus, the easy money, I have to tell you, has already been made, and we should not expect such robust returns in 2015. Like I said, from the top, next year will be far too much like the past year. That means overall gains in the 10% range with more volatility than you'd like to stomach. Likely 2,300 is something that sounds about where we are going to close out the next year, or actually 2015 year. We have a shot at 2,400 for the S&P if all the stars align together. If you are a long-term investor, then it's easy enough to patiently wait out all the all the consolidations, pullbacks and corrections to tally some gains. For active traders, and I believe most of us are active traders, you can use inverse ETFs and VIX trades to mop up some profits from those stock spills to add to your return. But please don't get too cute with these market timing moves. The market gods don't hand you a GPS system to perfectly navigate the twists and turns. Just remember that the primary trend remains bullish until proven otherwise. So don't stray under 50% long too often. And lastly, I want to discuss a couple of potential pitfalls. The outlook I shared is based upon the information in hand. As things evolve, it may get better, but it may also get worse. So let me now prepare you for two potential hazards out there. First of all, recession. I shared with you that the economic landscape is actually improving. However, the average expansion period between recessions lasts for 63 months. If that held true, we would have already seen the next recession commence in the second half of 2014. Gladly, this does not happen like a clockwork. Each expansion is unique, and this one seems to have plenty of life left in it. Yet, if the signs of the next contraction do start to appear, then the route to profits is by shorting the market. Inverse ETFs are the easiest tools to employ for that purpose, and for example, you can use the inverse ETF that tracks the S&P 500. SH is one of the inverse ETF. This tracks one-to-one the inverse movement in the SPY. If you want a leveraged inverse ETF, you can use the SDS, all right, which gives you twice the movement of the SPY, twice the inverse movement of the SPY. As you can see here, we are going upwards in this ETF because the market right now is declining. And you have the SPXU. The SPXU is the 3 times inverse ETF of the S&P 500. All right, so this is something you can make use of. The second pitfall is treasury bond rates. As I shared with you, there is an important historical relationship between treasury bonds and the valuation of the stock market. Right now, that is very favorable for stocks as bond rates have come down significantly over the past year. And signs point to rates staying low for quite some time, even going down further. However, you can easily appreciate that if rates started to rise significantly, then it would have a negative effect on stock prices, because it's going to actually put a good alternative for investors who don't have any other alternative, any other decent alternative for their money today. I believe stocks will do fine if rates just float up to around 3% on the 10-year treasuries. Above that, and it will start to call into question their relative value versus bond, which would spark a correction even if other economic indicators are positive. Alright, so what to do next? So what I shared with you may give maybe the false impression that I'm just rolling the slideshow backwards. it may give you the false impression that just about any stock will do good, but certainly you understand that some shares will do much better than others, as it did in 2000, as was the case in 2014. That's because the easy money in the bull market took place in the first 5 years. Now it will be slower going as the bull market matures. To put the odds strongly in your favor, you should actually rely and take into your considerations couple of systems that are going to give you much better performance than just the average. Part of these concepts, lots of ideas for great investments throughout 2015, I'm going to share with you in my Facebook page. So the first idea, the first bonanza I think we are going to see in 2015, I've already shared in my Facebook page, and you are more than welcome to jump and to see and to share your thoughts there. One of the best things in Facebook is that we have lots of discussions around the concepts and around the trading ideas that I bring up. Also, we are sharing screens and you can ask questions. So this is a great community that is just evolving all the time, and I really want to welcome you to our Facebook page. Also, you can when you are getting to the page, you can just click like, and then Facebook understands that you want to get this kind of material, this kind of posts, and then it's going to just push the information as it's getting posted to your wall. Thank you very much, all of you, for being here with me for the last 1 hour. I'm wishing you right now a great year. May you prosper in this year, and may your portfolio prosper in this year. And I'll see you all in the next webinar. I'm staying right now if there are any questions, but I just want to stop the recording right now. Thank you very much, all of you, for listening and for being part of this great expanding trading community. Right, thank you, Patty, for your comment regarding the Facebook. Phyllis, I'm going to write a couple of posts regarding the energy stocks, and the energy stock today is still plunging, so we still have time for that. All right, but I'm going to share a couple of stocks that I think are going to be good investments in 2015, and we really need to think out of the box in 2015 in order to win the market. All right, and I believe Scott or Aggie will be with us shortly. Cheers.